Welcome to this lecture on the fundamentals of the stock market. Today we're talking about understanding the risks and potential returns of investing in the stock market. Suppose you just turned 67 at the end of 2012 and had just retired. You would save for retirement starting at the age of 40 until you retired on your 67th birthday, having invested all of your contributions in the stock market and reinvested all the dividends. How well would you have done? If you began this saving with your first contributions to your retirement account in 1986, at the end of your first year of work under the retirement plan, assuming starting income of $50,000, an inflation rate of 2% per year, a real salary growth rate of 1%, and a contribution each year of 10% of your income, you would have ended up with $592,000 in your account at the end of 2012. Not bad for having not started to save until age 40. What if instead you had been a few years older and had started this with your first contribution, again at age 40, in 1983 instead of 1986? Your 67th birthday would have occurred at the trough of the stock market in February 2009. If you retired at that point, you would have ended up with around $429,000, or around 28% less than if you had started 3 years later. Now, with the benefit of hindsight, it is clear that people who hung in there with the stock market in February 2009 saw their balances recover. But at the time, there was great concern about the stock market. When you really get into the situation of having just seen a little less than half your retirement wealth evaporate in the span of a year, it's difficult to know what to do. If there really is mean reversion in the stock market, meaning that extreme increases and extreme decreases will level out over time, then why don't you just hang in there through the downturns and sell off your positions slowly during big booms. But this is a very difficult path to force yourself to follow. Specifically, when everyone is making money in the stock market, it's hard to force yourself to sell out of it. And when everyone is losing money, it's hard to stick with it or buy more stocks. And importantly, we don't really know if the stock market really mean reverts. We don't know that in all cases, after the market falls, that it will rebound. We only have one history of the stock market in the US. If we look around the globe, we can find examples of countries whose stock markets never recovered or took a very, very long time to recover. Here, for example, is a graph of the Japanese stock market, the Nikkei 225. It got almost to 40,000 points in 1989. It then fell to below 10,000 points. That's a 75% decline. By April 2013, it's recovered to around 13,000. But this is very far from the high of almost 40,000 at the end of 1989. In this lecture, we'll make some progress towards understanding the stock market. Many individuals invest in stocks, deciding that they like the risk-return trade-off that they perceive in the stock market. For example, consider 401k plans, the leading retirement saving vehicle for private sector workers in the US, with over $3 trillion of assets in them as of today. At least 44% of 401k assets owned by participants in their 20s is invested in stocks, and 41% of the assets for participants in their 60s is invested in stocks. Those figures don't even include other types of retirement account investments, such as target date funds and balanced funds, which also include some equities. And then there are the large pension funds that manage trillions of dollars of money to provide pensions to government employees and also the older employees of firms in more traditional industries. These pension funds have also chosen to invest in the stock market. At the end of 2012, state and local governments had around $3 trillion in US-based pension funds as well, with around $1.8 trillion in corporate stocks. The stock market consists of the traded equity stakes in all publicly traded companies. In this lecture, I won't be talking too much about individual stocks, but more about the stock market as a whole. One of the major principles that you learn if you study individual stocks is that there are substantial benefits to diversification. Diversification is the combination of the stocks of many different companies into a portfolio. What we are covering in this lecture is how financial economists generally think about valuations in the stock market. Financial economics views the stock market as it views any other asset. There are many different states of the world, whether the economy is good or bad, whether natural resources are cheap or expensive, whether inflation is high or low. And an asset is characterized by its performance in each of those different states of the world. Historically, stocks have had a higher return than risk-free assets, but that higher return is not guaranteed. And the lack of the guarantee, the fact that the stock market can generate much lower returns than the risk-free asset in some states of the world, is what makes it possible that the stock market can potentially deliver higher returns than the risk-free rate in other states of the world.